Welcome to the Explainer. So, if you're an ambitious entrepreneur looking to scale your operations up in Prince George, you already know that growth usually demands better tools, bigger fleets, and faster machinery. But getting that gear actually on the floor? Well, that means clearing two pretty massive hurdles. First, you've got to secure the capital to actually buy the equipment, and second, you have to navigate the surprisingly complex web of British Columbia's tax compliance. We're going to unpack both of these today so you can scale up without the stress. All right, let's dive right in.
So I want you to ask yourself a question. What is the true cost of upgrading your business equipment? Because let's be real here, the true acquisition cost involves a whole lot more than just the sticker price on a new CNC machine or a delivery truck. It's actually dictated by the speed and terms of your funding and the hidden and often completely misunderstood realities of provincial tax laws. I mean, if you get the loan right but you get the tax wrong, that shiny new upgrade can quickly turn into a massive headache.
Here's our roadmap for today. We're looking at 1. Equipment financing explained. 2. Qualifying for the loan. 3. The tax side of leasing. 4. Calculating lease tax formulas. And finally, 5. Special exemptions and rules.
Okay, Section 1. Equipment financing explained. Getting the capital you need, fast.
Because speed is literally the spark that ignites business growth. Just look at that massive $5 million figure. That is the funding ceiling available through Simply Approved business loans right here in Prince George. They can actually fund up to 100% of your equipment cost. And for clean files, the turnaround time is a rapid 24 to 72 hours post-signing. I mean, it's a completely different ballgame compared to waiting months and months for a traditional 5-year bank term loan.
And whether we're talking about a logistics company expanding its trucking fleet to take on a brand new route, a local restaurant owner bringing in industrial kitchen equipment right before the busy season, or even a medical practice upgrading their tech, this financing fits the day-to-day trades of Prince George perfectly. Plus, the equipment itself acts as the collateral, which just makes the whole process incredibly efficient.
Moving right along to Section 2, qualifying for the loan, what it actually takes to get approved.
So the crucial point I want to make here is that the barrier to entry is highly accessible. You really don't need a pristine financial history for this. You just need 6 months of business bank statements, your CRA business number and social insurance number, at least $35,000 in monthly business deposits, and just 6 months in business. And honestly, the most surprising part? The personal credit score requirement is only 500 plus. If you're an active, cash-flowing business, getting approved is highly realistic.
All right, Section 3. The tax side of leasing. Navigating BC's PST rules.
Okay, so you've got the cash, you've leased the equipment, you're ready to go. But now comes the plot twist, surviving the complex reality of the provincial sales tax. Welcome to the bureaucratic maze, folks. Now, to understand the tax, we first have to understand what the BC government actually considers a lease. Under the law, a lease is literally any agreement where a person is given the right to use goods. It doesn't even matter if it's hourly, daily, weekly, or monthly. If you are given the right to use taxable goods, anything from a giant construction excavator down to a standard office printer, in British Columbia, the PST rules apply to you.
So here is the baseline rule in plain English. For most taxable goods, your PST payable is simply the applicable PST rate, which in BC is a flat 7%, multiplied by your lease price. But keep in mind, that lease price includes almost everything you pay just for the right to use that equipment. We're talking down payments, disposition fees, mandatory delivery charges, and, yep, even late return fees. It all gets factored in.
But let's look at just how granular these rules get with something called the option to purchase rule. Say you sign a 24-month lease for some new office computers. At the end of that lease, you have an option to buy them out for a single nominal dollar. You're probably thinking, hey, it's just $1, no big deal, right? Wrong. The government actually views that tiny buyout as a completely separate, taxable retail transaction. You are legally required to pay 7% PST on that single dollar. So, 7 cents. I know, it's literally pennies, but it's a massive compliance trap if you just ignore it.
Section 4. Calculating lease tax formulas. What happens when equipment crosses borders and changes use?
Now, bear with me, there is a little bit of math here, but it is absolutely vital for your bottom line. Say you lease an excavator over in Alberta, but you bring it into BC for a specific 30-day job. Do you have to pay BC tax on the entire lease? No way. The formula actually works like this. You only pay PST based on the exact fraction of time the asset is physically located in BC. So you take your lease price, multiply it by the 7% rate, and then multiply that by your BC hours divided by the total hours in the rental period. You're only taxed for the exact time that machinery is getting dirt on its tracks inside British Columbia.
But what if you are a leasing company yourself, or you lease goods to release them to someone else, and you suddenly decide to take a piece of equipment out of your tax-exempt inventory for your own personal or business use? Well, that triggers a change in use, and suddenly, boom, you owe PST. But here's the catch. You don't owe it on the original purchase price. You owe it on the depreciated value of that asset.
And this right here is exactly how the government views the dropping value of your assets over time. Vehicles and trailers, they depreciate at 30% per year. Aircraft drop at 25%. General equipment is at 20%. So if you pull a piece of equipment out of your lease inventory to use yourself after a year, you calculate its new depreciated value based on these exact percentages, and then you pay your 7% PST on that newly reduced number. Simple enough, right?
Okay, finally. Section 5, Special Exemptions and Rules. My favorite part, finding the loopholes.
Now here is where really understanding the law actually saves you cold, hard cash. Notice the massive contrast here between a bare lease and goods supplied with an operator. If you just rent out a piece of equipment on its own, a bare lease, it is fully taxable. But if you supply that exact same equipment with a person to operate it, the government no longer even considers it a lease. It completely transforms into a non-taxable service. That means no PST charged to the customer.
Let's ground this with some real-world examples straight from the government bulletin. If you rent out a bouncy castle for a corporate event, that's taxable. But if you provide an on-site supervisor to monitor that bouncy castle for the whole event, boom, it's a tax-exempt service. The exact same thing goes for providing sound and lighting equipment with an operating engineer. The big key here is that the operator must be present on-site during the entire period, not just sitting at home on call.
Next up, we have the concept of bundled leases. This happens when a lessor rents out a mix of taxable and tax-exempt items all together for a single combined price. So how does the tax man handle that whole shebang?
Well, they basically require you to split it out based on fair market value. Take a look at this example. Say you lease a taxable electric scooter, and it comes bundled with a safety helmet. Now, a safety helmet is specifically tax-exempt in BC. In this scenario, the lessor must only charge PST on the fair market value of the scooter itself and completely ignore the helmet. You never ever pay tax on the exempt portion of a bundle.
But listen closely, because here is a critical warning I really want you to take away from this. If you lease equipment, let's say an industrial cooling system, and you affix it so permanently to a building that it becomes part of the real property, the government steps in. The law explicitly states you are instantly deemed to be the purchaser at a retail sale, and you immediately owe PST on the fair market value of those goods right then and there, on top of whatever lease tax you are already dealing with. So always be careful about how permanently you install your leased gear.
And that brings us right to the end of our journey today. We've seen just how fast and accessible equipment financing can be for a growing business. And we've successfully decoded the complex and sometimes pretty surprising world of British Columbia's lease tax rules. So I'm going to leave you with this one final thought. With the capital ready to go and the tax rules totally demystified, are you prepared to confidently scale your operations? Because I'll tell you, when you truly understand both the loan and the law, there is absolutely nothing that can hold your business back. Thanks so much for joining me on this explainer, and I'll catch you next time.